Still recovering from recession, Pennsylvania's Treasury is diversifying investments to offset painful losses, even investing in a federal program to bail out securities markets. But with state revenues lower than expected, the outcome stands between Pennsylvanians and legislators' calls for new taxes.
So a lot of times people don't really understand how relevant this office is to the overall tax burden discussion, and we try to remind them that if we are able to earn great returns, that should provide additional money.
John Liskow is the Chief of Staff for State Treasurer Robert McCord. He says Treasury is recovering by staying the course, but investments have still taken a hit, with 2008 showing a 2.73% yield for the Pool 99 fund and negative returns for the other two funds.
We, kept our calm here. We decided to stick with the allocation that we had come up with, and as a result of that, we were able to benefit from that market rally that took place from March, through 2009.
That resulted in a market value return of about $615 million back to the investment pools, leading to a large swing in yields.
In 2008, the funds were down in Pool 98 over 6.5%. Last year in 2009, they were up over 13%. So it's been we're still recovering from that 6.5% was a much larger number. So we haven't made it all back yet.
As part of the recovery, Treasury is investing in international equities and fixed income, and the Term Asset-Backed Loan Facility Program, or TALF, out of the New York Federal Reserve. Similar to TARP's bailout of banks, TALF bailed out securities and hedge funds.
So we went into that program, we took advantage of the federal government's leverage on it, and some of those returns from last year for what are essentially AAA rated securities, AA and AAA rated securities, which are very safe. We had returns, over 10%. Some are even approaching 15%.
He said the TALF program has created a $600 million benefit to the state, but the TALF program itself does not come without risks, said Tony Sanders, a professor of finance from the Mercatus Center in Washington, D.C.
You will see various states are supportive of programs like TALF for the following reasons, is that they have hedge funds that are located in Pennsylvania, and so it's in everyone's best interest if the hedge funds don't fall apart. Okay, that's the positive news to it. The negative news is that did TALF really help them survive? And the answer is that's not clear. Again, all TALF really did was provide a short-term liquidity primarily for hedge funds and other holders of these asset-backed securities. Now they have to pay it back.
If the funds do not recover, the cost would fall on American taxpayers, the same as the TARP program. And of the $1 trillion TALF had available, only $70 billion were used before the program ended this past spring.
There's no really good reason to purchase these assets at all for the following reason, is that once again, TALF was meant as sort of shock therapy. Shock the market into functioning again. All the assets that are in those TALF portfolios are still in bad shape and are going to take years to work themselves out of it.
Of the TALF programs Treasury has invested in, returns range from negative 9.8% to 26.9%. To date, TALF has yielded a market value increase of $13 million for Pennsylvania, and Treasury keeps looking forward.
We don't ever want to be the people who are going to try and chase a 15% or 20% return, because that's not our business here. I mean, the money that comes in here we need to be able to pay the bills.